President Donald Trump has said that there will not be any tariff exemptions on China-made electronics. But this comes after a Friday announcement from the U.S. Customs and Border Protection Office, which said that some of those products were exempt, at least for the time being. And joining us to discuss all things tariffs is Daniel Lacalle, chief economist at Tressis and author of Freedom or Equality. Daniel, thank you so much for coming on today with us. So there's some uncertainty here, right, about this tariff policy on electronics, which of course includes those oh so important semiconductors. So Trump is now saying, there's not going to be any exceptions, that China-made electronics, they're just going to move to a different tariff bucket. What are you expecting here, Daniel?
I think that we're in a very tough negotiation process, and that obviously what President Trump is doing is presenting different cases and allowing China in this particular case to step down and come to the negotiation table. The situation right now is very challenging because the United States government cannot present itself as showing any weakness, and therefore it is basically showing different hints to the Chinese administration to show them that there's only two options here: either negotiate or enter into a very significant trade war in which China has all the cards to lose.
Now, Daniel, you also said something last week when you were on our show that these tariff negotiations, they're really a negotiation tool for a freer, better trading world than the one that we've been seeing so far, but that it's also a completely different story when it comes to China, because here we've got geopolitical issues, we've got security-related concerns. What do you think Trump ultimately wants to get with these tariffs? Because it's not just about fair trade with China.
In the case of China, there's three elements. The first one is a national security issue that includes property rights, that includes the security of companies that are already investing in China and face significant challenges of intellectual property theft, etc. Additionally, there are also monetary elements. We have seen how China has been using the excess dollars coming to the Chinese economy from exports to try to undermine the position of the United States dollar in the world financial system. That has to end. And third, I think that's also something that has to do with the Ukraine war and the position relative to Russia. So everything is interconnected here. The Chinese government needs to push Russia to achieve a negotiation and an agreement with Ukraine. At the same time, China must stop its advancements to try to integrate a number of countries into a completely different system than the US dollar and the US-centric financial world, and at the same time improve the free market and improve the trading environment, lifting the barriers that China has, not just tariff barriers, but non-tariff barriers.
Daniel, I want to go deeper on this issue of currency, because we've heard President Donald Trump say multiple times in the past that China unfairly manipulates its currency. Now, right now, China is still putting on a front of we're not going to back down, right? So as it tries to hold on to this stance, do you see China potentially further devaluing the yuan to offset some of the pressure here?
Yes, the problem of China resorting to a devaluation of the yuan is that the last time that they tried, it caused an immediate havoc in the Chinese economy, and it actually led to the current challenges of the Chinese economy. It would be atrocious because it would be basically impoverishing the entire Chinese population for no reason, because at the same time, the problem of the yuan is that despite the enormous power of the Chinese economy, it's only used in 4% of global transactions. So the problem that China faces is that they would make a devaluation that would hurt Chinese citizens, Chinese workers, Chinese savers. However, it will have no real impact on the position of the yuan, because if the Chinese central bank doesn't start eliminating the fixing and lifting all the capital controls that the Chinese economy has, then all the monetary implications of Chinese decisions are going to fall entirely on the shoulders of citizens in China that are already suffering from an economy that is slowing down and is not doing as well as it could.
All right, Daniel, let's bring it back to the U.S. for a second, because we just heard National Economic Council Director Kevin Hassett. He told Fox Business that there's 100%, and that's a quote, 100% not going to be a recession for the U.S. this year. Are you as certain about that?
I don't really care about a recession the way that we know about it. Now, 2 quarters of GDP contraction, if they come from lower government spending, which is obviously one of the significant parts of GDP, I'm not worried as long as consumption remains robust, investment comes back to the level where it should, and the net export balance improves. So if the administration is going to cut government spending and reduce debt, and that leads to a short-term GDP contraction, that is not a problem. I think that Mr. Hassan is mentioning, and I think that this goes along with what Scott Bessent, the Secretary of State of the Treasury, is saying, is that there are no indications of a private sector recession, that consumption remains robust, that there is no challenge in the employment sector, and that in general, investment is strengthening. So I don't see the risk of a private sector recession. We already had a private sector recession in 2023 and in 2024. I think that the private sector is going to thrive because of the tax cuts, the deregulation, and the improvement in investment. That will also support consumption without resorting to higher credit card debt. And I think that investment in general is improving, and the net export balance is likely to do so as well. So I'm not worried about a short-term contraction of GDP if it happens, but if they obviously have much better information than I have, and if they don't see it, it's because it's unlikely to happen.
Daniel, on that note, one last question for you. I mean, it's been a wild couple of weeks for the stock markets. What's your advice to investors right now?
Oh, my advice to investors is not to panic on headlines that are discounting one thing and the opposite, and messages coming from a consensus that it was monstrously wrong in the first Trump administration, and that was monstrously wrong about negotiations of tariffs. Remember that the entire tariff tantrum, as I call it, was predicated on the idea that this was not a negotiation process. I think it's pretty evident that it is, and that it is a very successful negotiation process. In the next weeks, we're going to see a domino of trade deals that investors are going to obviously look from a positive perspective. And additionally, all these factors that we've mentioned about the economy are actually getting relatively better than what the trend was in the last 24 months. Therefore, investors should look at what we are seeing in the earnings season. The earnings season is actually relatively robust. We are also seeing companies that are not concerned about the current environment. They're actually continuing to provide good guidance. And in general, the outcome of this situation is going to strengthen the US economy. So it is going to be good for stocks, and it's going to be good for workers.
Yep, and we're already seeing Kevin Hassett saying more than 10 countries have come out with some pretty good deals. We'll see what those deals actually entail when they come out. Daniel Lacalle, thank you for joining us today.
Thank you so much. It's a pleasure.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.